All right, so this is the current events section, and this is actually what I've spent the back half of the week working on. I've been writing a series of pieces around this, and I have another piece that's going to come out soon that I'll share with you as soon as it's available. What I want to do with the current events section here is focus on the Eurogroup agreement that was made on the 9th of April. The agreement was reached late in the evening. This was 2 days after it was supposed to be reached. There was a lot of frenetic phone calling that took place. The meeting started at 9:30. The agreement was announced at 10:30. It was a real sort of nail-biting kind of traditional European Council negotiation, emergency crisis negotiation type thing. And yet what it really does is it just makes a set of recommendations from the Eurogroup finance ministers to the European Council, which is going to meet on the 23rd of April. So we've got another 2 weeks to argue over the things that have already been agreed. While we're doing that, I think what we should do is get a good sense of what the main components are, right? Now, there are lots of things that are described in this particular document. I want to isolate 5 that I think are the most significant. Some of these I'm going to put together in ways that may seem a little bit unfamiliar, but I think it's worth doing that. The first of these is the coronavirus response investment initiative and the support instrument. These are both instruments that are available to the European Commission, and they're available using elements from its own budget. There's the SURE program, which is the Commission's initiative from the 2nd of April. There's the European Guarantee Fund, which is something that the European Investment Bank has proposed to do. Then there's the Pandemic Crisis Support. That's supposed to come from the European Stability Mechanism. And finally, there's the European Recovery Fund. And when I introduce this, I'll put it together with the other big thing that the European Council needs to discuss, which is the multi-annual financial framework, because inevitably these two things are linked, even though the European Council is reluctant to conclude either conversation. Let's start with the investment initiative and the support instrument. As you can see, these are paragraphs 9 and 14 in the summit declaration. The investment initiative is something that is a very small amount of money in relative terms. It's money that was already allocated to cohesion funds, so 37 billion euros, but 37 billion euros for a 14 trillion euro economy is not a huge amount of money. And what it's going to do is give the Commission the opportunity to provide additional funding to support investments that will aid in the response to the COVID-19 crisis. And indeed, as of the 1st of April, it will also enable the Commission to begin making grants to member states that are hardest hit, up to 800 million, right? So 800 million for a country like Italy is not macroeconomically significant, but 800 million is still serious money, right? Even Jeff Bezos would be happy with 800 million euros. Having said that, this use of the EU's budget or the European Commission's budget is one thing. The other thing is the emergency support instrument that they're going to reactivate. That gives another 2.7 billion that the European Commission can allocate. And once again, this is grants. This is money that can be used for direct spend. It's not macroeconomically significant, but that doesn't mean it's worth discounting entirely. So we're talking about about 40 billion all told that can be spent. It would have been spent anyway, but now it can be spent with greater purpose in response to the crisis. The SURE program is actually a little bit more interesting. The SURE program is something that would be new. This is something that the Commission has proposed under Article 122 of the Treaty on the Functioning of the European Union as an extraordinary measure response to an emergency. What we're talking about is guarantees of 25 billion, right? So what they're going to do is get the member states voluntarily to contribute up to 25 billion, and then they're going to use that money in order to extend 100 billion of loans to member states to backstop their unemployment insurance programs. Now, again, this is potentially a significant amount of money. Italy could walk away with 20 billion of this, which is just slightly over 1% of Italian GDP. That's a significant amount of money. It's not macroeconomically significant, though. It would be useful, but it would come as a loan, and it would need to be paid back, and in the terms of the loan would be made as generous as possible. So I don't want to discount it. I think loans are actually a good thing, but I think we should be very clear that this is a loan, and this is a loan of up to 20 billion. It's a fund of up to 100 billion, because it all depends on them getting the paid in 25 billion of guarantees that have to be voluntarily committed by individual member states. So this is a good program, and I'm not trying to discount it, but I want you to pay attention to the fact that nobody's giving anybody anything except for the member states providing money to the European Commission in order to guarantee these loans. There's the European Investment Bank's Guarantee Fund, and that works much the same way, right? What's going to happen is the member states are allowing the European Investment Bank to set aside 25 billion of its capital in order to underwrite up to 200 billion in loans, but these loans will be made not to member state governments to backstop their unemployment regimes, but rather to small and medium-sized enterprises in particular, but companies in general, in order to backstop their services. Now, what I think is interesting about this is that the leverage on this is much greater, right? So you get 25 billion in guarantees to get 200 billion in loans, and the clients are riskier, right? Because we're not giving it to governments, we're giving it to companies. And companies are actually riskier than governments as borrowers. So we have to hope that we're actually going to get the 25 billion in guarantees, and that the 25 billion in guarantees is going to translate into 200 billion in loans, presumably loans from the private sector guaranteed by the European Investment Bank to finance the small and medium-sized enterprises. When they tell you that they have come up with a $500 billion package or billion euro package out of this, well, you've just seen where 300 billion of that money comes from. 300 billion comes from the 100 billion for the SURE program and the 200 billion for this. In other words, it comes from the 50 billion in guarantees that are supposed to be leveraged into 300 billion in lending. It's very important to keep track of what is the real money and what is the lending money, not because lending is a bad thing. Lending is good, but because when they promise this money, you have to ask yourself, okay, are people really going to provide this? Is it really going to materialize? And when it does materialize, is it really going to be macroeconomically significant? And so far, I would argue we have not gotten across that threshold yet. The pandemic crisis support agreement is what comes from the European Stability Mechanism. Now, this was obviously the most controversial part of the conversation, because what it relies on is the European Stability Mechanism to go out and raise funds to provide a credit line of up to 2% of a member's GDP to any government that wants it, right? So you don't have to qualify for access. Every government has access. Any government that wants it, for that government to use specifically and as the only requirement for financing of direct and indirect healthcare, cure, and prevention-related costs due to the COVID-19 crisis. Now, this idea of prevention-related costs is a little vague, right? Because presumably if all of us staying at home is what's preventing the COVID-19 crisis from spiraling out of control, prevention-related costs should extend to anything associated with our staying at home. I'm not sure that's what all of the framers of this particular passage meant, but that's one way it's being spun in the Italian press. The other thing is that it says quite explicitly that the provisions of the ESM treaty will be followed, and that this is only going to be available during the crisis. And once the crisis is over, then this particular credit line is going to evaporate, which makes you wonder how they're supposed to roll over any debt that they borrow. Remember, 2% of GDP, we're talking about 36 billion for a country like Italy. We're starting to get close to macroeconomically significant numbers, but they're going to have to pay that money back at some point, and when they pay that money back, then we have to ask some real probing questions about how they're meant to do that, and who's going to provide them the extra money. If they go to the markets, then they'll pay at a higher rate of interest. If they can't go to the markets, then they go to the ESM, but they go to the ESM under a different credit facility. And this is what the Italians are most concerned about, is that any money that they borrow either has to be repaid with credit that they raise out on the market, or it has to be repaid by going back to the ESM and going into a program. And that's why I've highlighted on the right hand of your screen, afterwards, Euro area member states would remain committed to strengthen economic and financial fundamentals consistent with the EU economic and fiscal coordination and surveillance frameworks, including any flexibility applied by the competent EU institutions. So only so long as the Stability and Growth Pact is held in abeyance is this not a problem. It becomes a problem, at least in the minds of the Italians, if the rules reset once the immediate crisis is passed and yet the financial requirement remains. That's why there's all this talk about a recovery fund. How do we fund activity after the immediate health crisis has passed? And the answer is, we don't know yet. And we don't know yet because they've agreed to work on this, but they haven't really figured out how they're going to do it, right? And they're going to look at ways to do something through the EU budget. They're going to look at ways that are going to be temporary, targeted, and commensurate. They're going to discuss this in terms of all the legal and practical aspects that would be involved. And while they'll be open to innovative financial instruments, those instruments have to be consistent with the EU treaties, and indeed they also have to be accepted by the member states. So the bottom line is they've created lending facilities that add up to 100 million for sure, 200 million for the EIB, another 200 million or thereabouts from the ESM, and then whatever money is in those initial programs that I identified, about 40 billion. So what is that? 200, that's how they get to 550 billion, right? So when they say we've got a big package of 550 billion that's rolling out, the big package of 550 billion is a bunch of loans that are going to have to be rolled over relatively quickly. They're guaranteed, but we're not quite sure that the guarantees are going to get leveraged up as much as is expected. And that's why, although it's good that they came to an agreement, and it is good that they came to an agreement, the agreement remains relatively controversial, particularly in the Italian context, where, after the agreement was announced on Friday, the opposition parties basically exploded with rage at the government for having signed up to this agreement in the first place. And we may not have to take that explosion seriously, but I think we should pay attention to it, because the tensions within the Five-Star Movement, the tensions between the Five-Star Movement and the Democratic Party, the tensions between the government and the opposition, these are not going away in the context of this agreement. If anything, they've only increased. Now, if we're still debating the recovery fund, we're also still debating the multi-annual financial framework. They've decided that this financial framework should be bent in some way to reflect the realities associated with the coronavirus crisis. But notice there's no language in there that suggests they're going to increase the size of the European budget. And in that context, I think what we have to do is begin to look at some of the language that they've pumped into this roadmap for recovery and begin to ask ourselves, what are they really trying to signal when they talk about reforms to strengthen resilience and competitiveness in line with the sustainable growth strategy? What are they really talking about when they're talking about conditions to relaunch our economies while promoting economic convergence in the EU and reducing any fragmentation resulting in the crisis? There might be meaning hidden in these phrases, and I can certainly read them in many different ways, but there's a signaling here that's incomplete, right? I'm not quite clear on where this is headed, but I can see that when the European Council meets on the 23rd of April, it's going to have a really difficult conversation once again. Now, having said that, what I think you should do is keep an eye on the political debates in Italy, but also in the Netherlands, where I understand the agreement has not been greeted with great enthusiasm either. We should begin to look at the underlying movement of attitudes toward Europe in the populations of both countries, but across the European Union as a whole. And we should pay attention to what the European Central Bank is doing in order to backstop and buy time for this whole effort, and how much straining it's putting on that institution. And here I would point you to the loosening of collateral rules that took place on the 7th of April. The amount of risk that's being brought into the balance sheet of the ECB is something that I think is going to create some controversy further down the line. The monetary policy accounts from the 11th and 19th of March, that should actually say the 11th and the 18th of March, that were published on the 9th of April, reveal some divisions in terms of both the understanding of the crisis and the willingness to engage in risk sharing across countries, and that risk sharing across countries is the crucial part, right? Because there's a lot of willingness within the ECB to share risk across firms from different countries, and to share that risk according to the capital key across the central banking community as a whole. But as much as they're willing to guarantee private debt, and as much as they're willing to encourage governments to guarantee private debt, and as much as the European Investment Bank is willing to offer guarantees on private debt, only the SURE program is putting guarantees on public debt, and nobody else is willing to put guarantees on public debt. And yet it's guarantees on public debt, arguably, that Europe is going to need the most, at least at some point in the future. And so it's an open question why private debt can be guaranteed more easily than public debt when private firms are more likely to go bankrupt than public entities. So we need to pay attention to that division and obviously watch this space. Thanks a lot.